Alright, if you're watching this right now, don't scroll. Something big just happened in silver, and it didn't happen slowly. It happened fast. In less than 24 hours, silver collapsed from around $120 an ounce to roughly $97. That's a minus 21.5% move. Overnight. We're talking about $1.4 trillion in market value that vanished before most people even woke up. And here's the part that should grab you. The real trigger isn't what the headlines are blaming. Both COMEX futures data and Shanghai physical pricing just confirmed the same thing at the same time. This wasn't a demand crash. This was a paper market event. Stay with me, because I'm going to show you exactly what just broke, how this pattern forms, and how you can recognize it before the crowd does next time. Now, before I explain what caused this move, let me teach you something most people never learn about silver markets. Silver doesn't trade like stocks. It doesn't even trade like gold. Silver trades like a leveraged pressure system. Think of it like a coiled spring attached to a bunch of borrowed money. When prices rise slowly, that spring stretches. When prices go parabolic, leverage piles on top of leverage. Futures traders add contracts. Margin stays thin. Liquidity looks fine. Until it suddenly isn't. And here's what you need to understand. Most people think prices fall because people stop wanting silver. That's not how these crashes work. These crashes happen because the system itself hits a mechanical limit. When that limit breaks, price doesn't walk down. It falls through the floor. So what does that tell us? It tells us you're not watching supply and demand anymore. You're watching the structure itself buckle under its own weight. If this is making sense so far, drop a comment below and let me know where you're watching from. I want to know who's paying attention to this. So here's what's actually happening. Let me break down the sequence the way it unfolds in real time. Silver had gone nearly vertical, from under $90 to over $120 in a compressed window. Leverage exploded. Open interest surged. Margin requirements didn't rise fast enough. That's the setup. Now the trigger hits. Could be a small price drop. Could be a margin hike. Could be liquidity thinning out. Once futures traders get margin calls, they don't sell because they want to. They sell because they have to. Forced selling hits thin order books. That pushes price lower. Lower prices trigger more margin calls. More margin calls trigger more selling. And suddenly you get a cascade. That's exactly what you just watched happen in real time. And here's what validates it. Physical silver in China didn't collapse. Shanghai premiums stayed elevated. That divergence tells you this wasn't real-world demand disappearing. It was paper leverage being flushed out of the system. When you see futures markets crashing while physical premiums hold firm or even spike, you're watching a structural break, not a fundamental shift. The paper market ran out of room. The physical market is still pricing in scarcity. That gap is everything. But here's the part that should make you pay attention, because very few people are talking about this right now. These events don't end trends. They reset them. And I can prove that to you with history. This is the exact same playbook we've seen before. And the outcomes matter. In 2008, silver collapsed over 50% in just a few weeks during forced liquidation across every asset class. What happened next? Silver launched into a multi-year bull run that took it from around $9 to nearly $50. In 2011, silver crashed nearly 30% after a parabolic move that looked exactly like what we just saw. It felt like the end. It wasn't. Silver consolidated, then exploded into another massive leg higher. In March 2020, silver imploded during global margin stress, even as physical premiums spiked to record levels. Sound familiar? That marked the bottom before silver doubled over the next few months. Every single time, the crash felt like the end of the world. Every single time, it was actually the purge. When you zoom out and look at the pattern, it's obvious. Violent leverage flushes happen near inflection points, not final tops. They clear out the weak hands, reset positioning, and create the conditions for the next move higher. That's not hopium, that's pattern recognition. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this keep going lower? Of course it could. Could there be more forced selling if margin stress spreads? Absolutely. Could this be some grand manipulation scheme? Maybe. But here's the thing. It doesn't actually matter whether there's a villain behind the curtain or not. The mechanics are what matter. Leverage plus illiquidity equals volatility. That's math, not conspiracy. The key is not guessing motives or trying to outsmart imaginary enemies. It's watching signals. Focus on what you can control. Structure, positioning, confirmation, not emotion. There are probably 3 types of people watching this right now, and I want to speak to each of you directly. If you're over-leveraged and you're panicking right now, let me say this as clearly as I can. Forced selling is how accounts blow up. Not because you were wrong about the long-term thesis, but because you didn't survive the short-term volatility. Survival comes first, always. If you're using leverage you can't afford to lose, your first priority isn't being right. It's living to trade another day. Risk management isn't sexy, but it's the only thing that keeps you in the game when moves like this happen. If you're a long-term holder watching price scream lower and you're wondering if everything just changed, here's what I'll tell you. Your job isn't prediction, it's verification. Watch physical premiums in Shanghai, London, wherever bullion dealers are quoting real metal. Watch stabilization zones where forced selling exhausts itself. Watch whether industrial demand indicators shift or stay firm. Don't confuse mechanical selling with fundamental failure. They look the same on a chart, but they mean very different things. One is temporary, one isn't. And if you're on the sidelines thinking you missed everything, and you're wondering whether there's still opportunity here, let me give you the lesson that matters most. The best opportunities often come after the violence, not before it. When everyone's euphoric and prices are going parabolic, that's when risk is highest. When everyone's scared and liquidations are happening, that's when asymmetry shows up. I'm not telling you what to do. I'm telling you where to look. The universal rule for all of you, no matter where you stand, is this. Don't confuse mechanical selling with fundamental failure. One resets the structure, the other breaks the story. Know the difference. So here's what I want you to answer in the comments below. Are you watching this as a holder, a trader, or someone waiting on the sidelines? And what signals are you personally tracking right now? I read every comment, and I want to hear how you're thinking about this. Now let me tell you where I stand, because I think it matters that you know how I'm processing this. I'm not euphoric, and I'm not bearish. I'm observant. First, I'm watching the $95 to $100 zone for stabilization. That's where forced selling usually exhausts itself in these types of moves. If price can hold above that range and start building a base, it tells you the mechanical pressure is done. If it breaks below and keeps grinding lower, it tells you there's more leverage that hasn't been flushed yet. Second, I'm watching Shanghai premiums closely, especially anything above 20%, because that's historically where physical markets start pulling price back up. When physical buyers step in aggressively while futures markets are panicking, that divergence creates the conditions for a snapback. Third, I'm monitoring open interest and margin adjustments across COMEX, because that tells you when the leverage is actually gone. When open interest drops sharply and margin requirements stabilize, you know the system has reset. Based on my analysis, this move was mechanical, not emotional. The fundamental picture didn't break. Industrial demand hasn't collapsed. Mine supply is still constrained. Central banks are still buying. Monetary conditions haven't shifted. What broke was the leverage structure in the futures market, and that's a temporary condition, not a permanent trend shift. If history rhymes, and silver stabilizes in this zone and then starts rebuilding momentum, the move that follows could be significant. I'm not making a prediction. I'm showing you what to watch for. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I'm telling you. Don't take my word for anything. But if you made it this far, you're thinking critically, and that mentality will serve you well. Most people react. You're analyzing. That's the difference between surviving these moves and getting crushed by them. If this breakdown helped you see what's actually happening beneath the surface, share this video with someone who needs to hear it. Subscribe if you want more real-time analysis when these patterns show up. And stay ahead of the noise, because that's where the edge is. Think critically, verify the data, and make your own decisions. Stay sharp out there.